Okay, we're going to get started. It's 5 minutes after 11. My name is Timothy Hayes. I am the Executive Director of AIR CRE, and I want to thank all of you for attending today's town hall meeting, which is being moderated by Adam Dearling of West Harbor Capital and featuring industry superstars Barbara Perrier of CBRE and Kevin Shannon of Newmark. I have to say, if we could have gotten either Barbara or Kevin, it would have been a big win. Having both of them at the same time is absolutely awesome. And I have Natalie Bazarovich to thank for that. Natalie is on the AIR CRE Board of Directors, and she's a very successful office broker with CBRE. And it's because of her relationships with Barbara and Kevin that we were able to get both of them. So big thank you to Natalie. I know you're on the call right now. So this is the 7th town hall AIR CRE has hosted in the past couple of months, and it's titled The Effect of Coronavirus on Capital Markets. Barbara and Kevin will be providing valuable insights into a number of compelling capital markets related topics, which Adam will cover in just a couple of minutes. Before I introduce Barbara, Kevin, and Adam, I want to touch very quickly on a few items. First one is that the next town hall that we will be hosting, and you do not want to miss, will be held on Thursday, June 25th at 11 a.m., and it will feature Spencer Levy and Kurt Strassman, both of CBRE. Mr. Levy is Chairman, America's Research and Senior Economic Advisor, and Mr. Strassman is the Executive Managing Director for Orange County and the Inland Empire. The title of that town hall is Economic Trends in a Time of Uncertainty. Spencer and Kurt will look at the economy from both a national macro view and then dial it in to discuss what is happening in California with a special focus on Southern California. By the way, if you have never heard of Levy, he has appeared on every major network discussing the economy and commercial real estate. In fact, earlier this week, I saw him on CNN being interviewed and being asked questions about when he thinks the offices will get populated with workers again. So keep an eye out for the communications that we'll be sending. When you receive them, make sure to register and then share those with your contacts. As with previous town halls, this session is being recorded, and we'll make the recording available on Monday. Once it's ready, you'll receive an email. We'll take you to our website, and then you can view it again, or you can share it with your contacts. Today's session is going to be a bit different than previous town halls. As I mentioned, today's session is being moderated by Adam Dearling, and it will be more conversational than the previous town halls we've had. After Barbara and Kevin provide opening remarks, Adam will engage them in a lively Q&A. Now, if you have questions during the presentation, you can ask those questions through the chat box, and time permitting, Adam will get to those at the end. As always, I want to thank Stephanie Plattner of Playa Creative Partners for all her help organizing these town halls. Stephanie has been involved in CRE marketing for the past 15 years and has developed quite a reputation in the industry. If you or your clients have marketing needs, I highly recommend Steph and Playa Creative Partners. So let me read the bio. So the moderator for today's town hall, as I mentioned, is Adam Dearling. He is a managing partner of West Harbor Capital, a private equity firm focused on the investment and asset management of industrial properties in Southern California. Prior to starting West Harbor Capital, Adam was a vice president with Industrial Property Trust, where he was responsible for the management of over 41 million square feet of industrial properties. Before working on the owner's side of the business, Adam was a successful broker with CBRE and Colliers, and he's also a past and most likely future board member of AIR CRE. Barbara Perrier and Kevin Shannon, during their 30-plus year careers in commercial real estate, Barbara and Kevin have been involved in thousands of transactions totaling millions of square feet and billions of dollars of transaction volume. In fact, if I were to list all of their combined career accomplishments, it would take much longer than the 60 minutes we have for this morning's town hall. It's really staggering to see all they've accomplished. So although we can't cover all of it, I do want to highlight a few accomplishments that I find most interesting. First of all, Barbara, she holds the title of vice chairman, which is the highest title a producer can achieve and is held by very few professionals in the CBRE network worldwide. Barbara is a member of CBRE's Colbert Coldwell Circle, which is an elite group that comprises the top 3% of producers in the entire company. And Barbara has won this award 16 times since 2001, including every year since 2010. Recently, Barbara was awarded the William H. McCarthy Award, which is given to one CBRE producer each year for materially impacting the culture, driving excellence, and unselfishly leading by example. The last highlight I want to mention is that in 2019, Barbara and her partner Darla Longo and their team completed 80 transactions, 80 transactions, with a value of more than $16 billion. To put that into perspective, there are only 260 working days in a year. So that means that Barbara closed a significant transaction every 3 business days while working with some of the most recognized companies in the world. That's absolutely phenomenal. Kevin Shannon. Kevin currently works with Newmark Knight Frank as co-head of U.S. Capital Markets, where he leads a team of 33 professionals representing domestic and offshore investors in 16 markets throughout the Western U.S. In his 35-plus year career, he has sold more than $65 billion of commercial real estate across all property types and asset classes, and has spent his career helping clients structure transactions to best meet their goals, and in doing so has been involved in some of the biggest transactions on record, including the sale of the following landmark properties: Amazon's headquarters, One Wilshire, the campus at Playa Vista, the CalMart building, and City Tower. Kevin is also very involved in his alma mater, USC, where he serves on the boards of both the Lux Center for Real Estate and the Sol Price School of Public Policy. And if that is not enough, Kevin has been an avid supporter of Catholic Big Brothers and Sisters Los Angeles for the past 20 years. And I forgot to mention at the beginning that Barbara is a graduate of UCLA. So for today's town hall, AIR CRE has brought together a Trojan and a Bruin. Mr. Dearling, it is all you.
Thank you, sir. Appreciate the opportunity to be part of this town hall and looking forward to the insight from both Barbara and Kevin related to the effect of coronavirus on the capital markets. As you alluded to, Tim, given Barbara and Kevin are two of the best capital markets broker in the industry, their real-time perspective should provide for an extremely informative discussion. So with that, and in an effort to really embarrass my children if they ever get their hands on this recording, let's go. So given the industrial sector today has been coined as the darling of the commercial real estate market, let's start there. Good morning, Barbara. How you doing?
Good morning, and nice to talk to you all. I have to say that the one thing that we've been doing a lot of is being on calls day in and day out with clients who are asking the same questions of what is the effect of coronavirus on our market. So I've had a lot of Zoom calls, a lot of different information gathering, but let me just start with a big picture of what we've seen in the industrial world. You know, since we've hit the post-COVID time frame, we've closed 10 deals. It's about 3.1 million square feet and about $412 million worth of real estate. So there are deals happening, but we had quite a huge book of business right when this happened in March that was going to hit the market, that probably about 70 to 80% of it just went all on the shelf. And what we're finding today is that a lot of the investors just pulled out of the market for a few weeks, but I'm happy to announce that at this point, people are starting to come back in. And we're starting to see a renewed kind of comfort level, and the industrial is certainly, as we'll talk about throughout this, is rebounding quicker than some of the other specialty types. A couple things to point as far as the capital markets and what's been happening. So before COVID hit, I'd say that there was more money chasing value add deals. And when it hit, it kind of almost switched overnight to having everybody look for core deals with, term and credit. Obviously, those are easier to figure out in times of financial uncertainty. We also saw people really gravitating towards bulk buildings. So, the Amazons, the FedExes, the big buildings. So that was another kind of trend. The industrial, like light industrial, was a little bit more difficult. And the reason is that there was a lot of upset in that rent roll and, asking for rent relief and people not being as sure what was going to happen. So I would say that was a little bit tougher, and pretty much all the multi-tenant deals that we had on the market have been saved for a later date this year. but the bulk stuff was moving through. Another interesting fact is truck terminals were in big demand, as we've seen, what's been going on in e-commerce. So there was some real highlights that could move through this COVID period, and there was some stuff that just had to be put on the shelf. I would tell you that, overall, as we look at the market, and we talk about, who's in the market and who's not, every day more and more entrants are coming back in. And there was probably a 2-month period where everybody was on the sidelines, and the people that were moving were people like the Amazons of the world, the DHLs of the world, and the people who had real interest. From an industrial perspective right now, in the last few weeks, and I'm sure many of you on the phone have experienced this, it's almost like the light switch has come back on with the leasing market. We've seen a tremendous amount of tenant activity and leases getting done. And what that's going to translate it is to better capital markets. So as we go through the presentation, you're going to hear that, what the effect of pricing has been. But my sense is if the leasing market continues to rebound as, beneficial as it has in the last few weeks, we're going to be in a pretty good spot. So with that, I'll turn it over to Kevin.
Yeah, thanks, Barbara. Kevin, I think you might be muted. I'm going to take a flyer here and say that the office world has maybe a bit more to figure out as compared to industrial since this global pandemic hit. So similar to what Barbara just went through, maybe you can give us kind of the state of the office market today as compared to pre-COVID.
Yeah, first off, happy Friday. And Adam, did you go to USC or UCLA?
I am a Gaucho, the University of Santa Barbara.
Okay, just wanted to check. Anyway, what Barbara said echoes true for the office market as well. There was a ton of value add capital, and like overnight, everyone went to core and core plus. We are not the darling right now. We have more issues, but I guess big picture wise, heading into this, the fundamentals on the office market on the West Coast were phenomenal. We needed more big block space in West LA, in San Francisco and Seattle. Vacancy rates were low, rent growth was great. It was all good. By the way, it was at the end of the longest recovery in history, right? So it should be good. So we went into this, but the good news is, this is a self-inflicted recession, right? And I think it's passed, based on the reports today. I think we've gotten through the worst of it, which is great. And we didn't over leverage, and we didn't have a .com situation. We didn't overbuild. We don't have a banking crisis, which is a big difference from the last recession. And so we have a lot of, there's the potential for a quicker recovery because of that. Office, like Barbara, we had a lot of deals that we were going to come out with. I'd say 85% of them went to the shelf. We paused most of them. We're selling, I think, the best West Coast core office deal in Seattle. Right now, we thought we were going to get 11 bids on a $700 million deal. The bid date was March 17th, which turned out not to be a happy St. Patrick's Day. But we paused the bid date before that, and the debt markets went crazy too, and we'll talk about that, I know, later on. But we are, industrial's coming back much quicker than office. Office, there's a lot of, institutional buyers need more data points for office. And we're going to talk about how office is going to be used post-COVID. Are we going to need more space, less space? Are we going to work from home? But we also need to see where post-COVID rents are. And we also need to see what the velocity of the recovery is, and then the utilization of the office after that. So I think office is going to take longer to come back. I think the second half of the year will be more promising. Right now, a lot of the deals are getting done are corporate sellers. If you don't have to sell, you don't really want to sell in this kind of debt market, although it's phenomenal how quickly the debt market is turning. We'll talk about that. I think sales in the second quarter are going to be off 60, 80% if we follow what happened in Asia. And so, but I do think, in terms of where the values are post-COVID, there's a big dichotomy for value add deals. They're getting hammered much harder. If you talk to the Newmark Appraisal Group on a value add appraisal right now, they're going to say, hey, we're going to assume conservative rents, no leasing for 1 year, no rent growth for 2 years. And so that when you add that underwriting together, your value add deals are going to be off 20%, maybe more. The core deals, we've got some data points now, and pricing's off, 5 to 10% generally. Most of the capital though wants 15% off, and the sellers want 5% off. So there's a big bid-ask spread there. Underwriting has changed. Your rent growth has changed clearly, right? You have a recession in your underwriting now. Your retention ratio, a lot of capital's lowering the retention ratio by 5%. Your leverage is lower right now by generally 5%. Your vacancy collection loss has moved up. So all these things have added up to affecting your value. And we think the deals that are going to come out first are going to be the core plus variety, especially those deals that have a strong weighted average lease term, and taking advantage of what I think will be a good debt market here in the next quarter or two. We actually, as Barbara said, it feels a lot better now. We actually closed 2 deals this week, and we reached agreement on 3 other deals. And so we're actually, the one thing about this downturn that was unique is the speed of the shock was amazing, right? It was just boom. It hit so hard and fast. You didn't see it coming. I think capital's now adjusted to it. A lot of these acquisition guys are antsy. They want to go do things. And I think, for the most part, nationally, the stay-at-home orders will be over by July 1st. And so it feels like, things are going to get better from here. So that's it, Adam.
Okay, good stuff, Kevin. Thanks. Let's stay with you for the next topic, and you just touched on it as part of your overview here. But as we all know, one of the most significant driving force in the capital market space are the debt markets. So I think you said the debt markets went crazy, which is probably a good statement and maybe an understatement. But today, how are lenders viewing the market, and which segment of the office market is most favorable?
I mean, lenders, transitional debt's going to take longer. And so the spreads on transitional debt have really gapped out, and construction debt's the same way. And I think you're going to see more activity on construction debt from the industrial side, which Barb will touch on. But, for just to give you an example of what happened, like on the deal I mentioned in Seattle, the debt quotes this is a core brand new CBD asset, 21 tenants, 97% leased, weighted average lease term over 10 years. We were getting 2.75% 10-year IO debt first week of March. By the end of March, that same debt was 4.25. So it went from 2.75 to 4.25 on a 55% loan in the matter of a couple of weeks. Today, it's back to 3.25. So we're getting, it feels a lot better. The CMBS market shut down, right? And it froze, and now we're doing our first 2 CMBS loans. 2 weeks ago, if you had to guess where a CMBS execution was going to be, you probably would have guessed the high 4s. But we're getting deals done, quotes right now coming in at around a 4. So that's very good news. We need to get that engine started again, especially for a lot of the secondary markets. And what the Fed did, by the way, the reason the interest rates went so high is because the corporates went so high. And so the Fed stepped in, and the Fed's been great. I mean, they've been really great. And so the Fed stepped in, they put CMBS into the TALF program, which really helped what we're seeing right now in the market for that. And then they also, when they started buying corporate paper, the spreads came down. And so, we're going to be in a very low interest rate environment for a long time. Treasuries are going to be low. The spreads are now normalizing. I predict, that the debt market has bottomed. It'll continue to get better. And the debt market's always important for providing liquidity to the market, as you know, Adam.
Good stuff. So who's most active today in the lenders world?
I mean, we're seeing the banks have a long way to go. And as I said, transitional debt's not there. We're seeing the life insurance companies come back into the arena for the core low leverage deals. And candidly, what we're trying to monetize fits the core profile more. So the life cos are the primary lenders you're going to see on those type of profile deals. And they're coming back in there. And then, in the secondary markets, we're doing a couple of CMBS executions. and I talked about that. The other thing that's happening, there's a lot of private capital sales right now. When we look at who institutional capital buying office right now, there's one institution buyer right now that's buying office that we've seen. Really, there may be one or two more that I'm not aware of, but a lot of these trades are private capital, right? And the private capital guys, those trades tend to be smaller, and these guys tend to go to their local regional banks who are still active and taking advantage of the sort of the freeze a little bit in the lending market. And so a lot of the local regional banks are busy, but the life cos are back, CMBS is coming back, so it looks promising.
Good to hear. Thanks. That's good insight. So Barbara, I'll throw that question to you. How are the lenders viewing the industrial market today, and which segments of the industrial market are viewed most favorably?
So I would tell you that similar to what Kevin said is about who's back in, that's the same in industrial, but there's many groups that are under allocated in industrial. So there's a lot of lenders really trying to get into the industrial space. They've seen the positive things that are going on in the industrial market. So I would tell you that the industrial world is kind of a sweet spot for the lenders today. I would tell you anything that's bulk and core is easy to finance. One of the spots that has been a little bit more troubling has been, when lenders are trying to take more risk in, vacancy or, rent rules that are not so stabilized. We've seen that construction lending is getting better. For a while, it was pretty tough. We will see that construction lenders are really looking at the sponsorship and the markets and the dynamics that are going on. It is coming back and getting better. I think it's really important for the capital markets to have this debt market kind of solidify. It was probably one of the big reasons in the past few months that we were having a difficulty getting deals done. I would tell you that there's a lot of life cos right now looking to lend for industrial. We just, Val Ochtemeyer and our team was able to do a deal with Nuveen, PGIM, all the life companies are coming back in a big way looking to kind of beef up their allocations in industrial lending. And we've been pretty impressed by that. I think Kevin talked a little bit about what's been happening with rates, and they're kind of been in and out. And the one thing about the debt market is that we have to kind of look at it weekly, or at least for the last couple of months, we've had to kind of take a weekly assessment of where we're at. And a lot of the buyers right now that are the strongest are ones that can come in all cash and worry about debt later.
All right, good stuff. So let's keep you on the mic, Barbara, and development. Let's jump into development. It was obviously an extremely healthy place pre-COVID, given we were in a market where land prices continued setting new record high with each new transaction. So since COVID, what's the industrial appetite for land today? And I'll piggyback on that question with, what is the general sentiment amongst investors as to land values today versus pre-COVID?
I think that land has been one of the sweet spots today. What we've seen is that because of some of the dynamics and fundamentals that are going on in industrial, we're able to move industrial land pretty easily. So when this started, we had several larger industrial sites on the market, and all of which are now kind of in escrow or spoken for. We had a large port-related deal in Hawaii that we were able to find a large internet company that would like to buy that piece of land in Hawaii, and we moved that through, and we actually exceeded our pricing goals and objectives on that piece of property. And then we priced another piece of land that's adjacent to LAX, the Johnson & Johnson facility, in a highly competitive bid process. And again, we were, at our kind of pricing targets. Two things I would say about those deals, is that both of them involved a short-term seller leaseback, which I think helped a lot of the bidders because the leaseback gave people a little bit of a comfort that we'd be well through this COVID period by the time that they took over the site. We've had another site in Torrance that we have an escrow, and we are optimistic that that will move through. We are about to take to the market several sites in the Inland Empire, and given the dynamics there, we know that that will move through. You asked a little bit, Adam, about pricing. What I would say is this: I think people's basic kind of return on cost and return metrics are the same in industrial. That might not be true of other product types, but based on the demand and the fundamentals, I think they're the same. What's changed and what investors are looking at differently is some of the assumptions. So instead of, being pretty aggressive on rent growth, which we saw pre-COVID, people are dialing rent growth back, in some cases saying, hey, we don't see rent growth for a year. I don't necessarily believe that, because I think that the fundamentals that we can talk about a little bit later are going to help drive that, but that's what investors are doing. They also are probably beefing up a little bit on their downtime. So if you start looking at rent growth and downtime in a pro forma, even if your return metrics will be the same, it is going to have some impact on the land prices. And the only instances where we did not see that as much is the ones that had, a 12-month, 18-month lease back, because I think people feel like in that period of time we'll be in a better spot. So I would tell you that there are some softening of land prices. I think it's deal specific, but as everybody on this call knows, entitled land in California is like gold, and the industrial market, the need for Class A industrial space has been good. So I think that the land market is a bright spot for industrial.
Good to hear, and I agree. So Kevin, same question to you in the office space. How has the story changed as it relates to the appetite for land in the office sector?
Yeah, no, just to comment though on land, because we're doing a couple of industrial parcels right now, and I wish I had more industrial land than office land. And so we're, we put a land industrial site in escrow about a month and a half ago, and pricing was off, 10%. We're doing buyer interviews today and yesterday on the 77 acres in Long Beach with Boeing. That was a completely different process. So the market's moving quickly. We've got another site up in the Seattle area too, but what we're seeing, which is really interesting, is we had 14 bidders on the Boeing site in Long Beach. We're going to pick somebody probably Monday, but the pricing's higher than it was a year ago for the C-17 site. So that tells you how, for great land, how much in demand it is. So that's if you contrast that to office land, it's, the office land deals are on pause. We've seen some office land deals blow out in markets like Seattle. We do think, the one thing about land deals is you're looking at where's the market going to be in 3 years or 4 years. And I think everyone's attitude toward, that lens always looks good. We're going to be past this virus. And so those deals have been paused. I wouldn't be surprised if a few of them are going to come back after Labor Day. But, again, office is an industrial, and industrial is going to be leading us out of this recovery. Oh, by the way, there's life science and data centers are as well. I think you're going to see a V-shaped recovery for industrial, logistics, life science. For office, it's going to be a little bit more gradual.
Okay. So I guess one of the questions we're all hearing about in the office space is tenant demand, and just how the landscape is going to change as the requirements come in for spatial distancing and so forth. So what does tenant demand look like going forward, and what we would expect that there would be a change to it? How are office landlords preparing for that change?
Yeah, no, it's a great question that we get asked frequently these days, and the honest answer is nobody really knows, right? That's the honest answer. But I think if you look back at 9/11, when 9/11 happened, everyone's like, "Oh, no one's going to lease the top floor of high rises, and nobody's going to want to go back into work in high rises." Well, that didn't happen. About a year later, everyone was leasing the top floor of the buildings and got comfortable again. It's also going to depend on the market, right? If you're in New York City, only 12% of your workforce drives to work, right? And so you really need to take the public transit to get to the office in New York City. So that's gonna be completely different. I mean, most of your audience here on this call today is going to be Southern California, and most of us drive to work, and there's a lot of, there's a lot of low-rise product that's easy to access. So I think it's going to be a much different story. But I think, you've got two things at play here. You've got the de-densification of the office because of the virus. And we saw, the average per square foot per person go to from 300 to 200. If you look at a company like Disney, it's 175. If you look at WeWork's New York facility a year ago, it was 50 feet per person, right? And so that's going to change. And so the de-densification, I think, is going to offset the working from home. But what I will say is, we're in a, Southern California is a gateway market area, right? Market areas that are gateway markets that are expensive, you pay the rent because you've got a lot of talent there. You got revenue producers, you got creative talent. That talent needs to come to the office and collaborate. And you get disjointed when you're not seeing people and you're working from home. And office landlords have spent billions of dollars amenitizing campuses to attract and retain the best talent. Well, you're not going to attract, if you're working from home, if you're the best guy from SC in your law school and you want to go work for a law firm, you're going to go work for the law firm that's in their office where you can be mentored, you can learn the culture, and you can grow. You're not going to go work for somebody that's working from home. And so I think you can't create culture on Zoom calls, in my opinion. So I think, like, my team wants to get back to the office. I think the vast majority of people want to get back to the office. I think you're going to see more work from home. And by the way, Facebook, 5 years ago, you didn't have to go to the office on Wednesdays, right? So Wednesday was work from home day. You might have 2 days, but you're still going to need your office space. It's not going to be as densified. And the work from home experience has been successful, but it's also been successful when we've had a stay-at-home order where there's nothing to do but work, right? And so there's a lot of distractions during a normal course of the day when you don't have stay-at-home. And so I do think office is going to come back. I think in the short term, your operating expenses are going to go up, probably about $1 a foot for the extra cleaning and all the extra things you're going to have to do to get your buildings ready. But I think in the long term, office is here to stay. And people in the expensive markets need to get together, and they don't want to feel disconnected. I do think, by the way, if you're a call center, that's a different story. I think call center employees could work from home, right? And but in the gateway markets that we're in, the competitive advantage is going to trump cost, and so you just need to the competitive advantage comes from collaborating and being in the office.
Yeah, it appears culture is the big underlying conversation here of getting everyone back to the office. So it's good to hear your perspective that it will return. And as you started that question or that answer with, nobody knows at this point, let's just hurry up and wait a bit. One more thing before we go back to Barbara. You mentioned WeWork and their spatial requirements pre-COVID. It's obviously a very interesting segment of the market and had its own, maybe call it issues pre-COVID, but where does the co-working business model go from here?
It's in for a rough patch right now. It's here to stay, by the way. It's not going away. But I think, with social distancing, hotel concept, bench seating, all these collaborative, these common areas and all these touch points, they're going to have to change the way they operate. But co-working and the flexibility they offer, it's here to stay. I wouldn't, but in the short run, it's going to be tough, given the social distancing, everything that's going on. It seemed like a great idea. WeWork had a tough time. I know Newmark and JLL are representing them, trying to renegotiate all the leases nationally. You're going to see some big space givebacks by them. But I think if you fast forward 3 years, co-working is going to flourish. Next couple of years, it's going to be tough. And the other thing is, when you're looking at office space absorption, unlike e-commerce, right, which might go from 13% to over 21% growth, right? Co-working's been taking up about 1/3 of our absorption, right? So nationally, co-working's accounted for the last 18 months 1/3 of your absorption. You take that out of the equation, it's a different recovery than industrial, clearly, right?
Sure. Yep. All right. Thanks for all of that. Barbara, we're going to swing it back to you. So the number of industrial investors have, a number of them have put their pencils down, especially right at the start of this. You mentioned previously that, as of the last few weeks, leasing has picked back up, which is going to be a lead indicator on getting the investors all back into the market. But, there's still transactions taking place. Of those that are active and those that are coming back into the game, where is the investment opportunity in the industrial market today? And I'm guessing there's going to be an e-commerce answer in you, but where does it go in the future as well?
So the good thing about industrials, I think that all segments right now, there's different investors with different investment strategies and niches, but I think that because of some of the things that are going on in the market, that all segments are going to see a tremendous amount of activity, especially in the third and fourth quarter this year. I think it's going to be a very, very busy, end of the year for everybody. I would say that, the quarter Amazon I think that's going to be very frothy through the end of the year. We're selling a bunch of Amazons now. There's a tremendous amount of interest in that. I think that, truck terminals, logistics, DHL, FedEx, those types of facilities are going to be very sought after. But personally, I think that, the multi-tenant park might be, or the multi-tenant world, that might be a place to focus. And I would tell you this, we often get the question asked of what kind of discounts are you taking post-COVID? And this is how I would categorize it. And it's hard to categorize because we're doing this on very few deals and every deal has its own nuance. But I would say in gateway markets right now, today, it's probably a 2.5% difference, for core gateway. Maybe with the multi-tenant parks and things of that nature, we might be at 5%. And the biggest discount we've seen has been about 8%. And that's been in markets like Las Vegas, or markets where there's been more, kind of COVID hit tenants. But I think that's short term. I think those discounts are gonna, pop back up in the third and fourth quarter because of demand and some of the fundamentals that we're seeing. So I would say that, right now, a lot of the groups are coming back in the market, and I think that they feel like, hey, things shouldn't be different than what they were pre-COVID, except maybe some of those underwriting. But I'm pretty optimistic that all segments of industrial will be good. I talked to my retail colleagues. I've talked to, office, as Kevin's been talking about. I do think multifamily will continue to be strong as well.
Great. Who are the most active buyers right now? They kind of remained active all the way through this COVID issue. Obviously not specifically names, but what type of buyer has remained strong?
Yeah, so we've seen, 1031 exchange buyers obviously kind of active throughout this whole thing, and we've seen some of the pension funds. I would tell you that most REITs went on the sidelines. There's a few that still were active. I think they were watching their stock prices. What I do think happened in the last couple months is a lot of the people that are traditionally buying were so tied up, and people who were acquisition officers suddenly became asset managers because they had a huge list of tenants that they were kind of dealing with, and so now those things are stabilizing, and those acquisition guys are getting back out there and coming back out. But I would say pension funds were most active, and 1031 exchange buyers, and private high net worth equity guys. But the private folks and some of the groups that were trying to buy, they were hoping for kind of distress, and people were out looking for distress, and there was very few distressed opportunities. I mean, we saw a couple, maybe some retailers that had warehouses that needed to quickly get something done, but I don't even consider those deals that got done distress. I would say it was more maybe a slight benefit to what it was before, but we haven't seen distress in the industrial world.
Okay. Thank you, Kevin. Same question. Where's the investment opportunity in the office market today? And then, as Barbara touched on, I do think there were a lot of groups on the sideline, but ready to jump at all of this distress that was potentially coming. And, in the industrial world, as Barbara mentioned, we really didn't see it. So, where do investors look to buy right now in your space?
you know, as I said at the beginning, we weren't really over leveraged or overbuilt. I don't see a lot of distress. And the one thing I will say is the Fed learned how to react during this financial crisis. I like to say they did in 18 days what it took 18 months for in the last crisis. Lenders also learned from the last crisis, and lenders did the pretend and extend game on office deals last time, and they were rewarded for that because time, had increasing asset values, and so they learned not to sell in the teeth of the crisis. Your value add guys are buying paper on retail and hospitality assets. There's very little value add for office. I think there might be opportunities, and it's still early days, but there's going to be opportunities for recaps. I think for some of these transitional assets, I think there's a need for some rescue capital potentially for some of them. We're doing a value add deal in San Francisco right now, and we're doing some pretty attractive preferred equity because it's hard to trade value add deals right now unless you have some creative structure. The deals are going to come out first are the core plus deals. And, I think if you can get a great asset with a 10-year weighted average lease term that's brand new, and you get it off at 6 or 7% or whatever the discount is, it's more of a discount than industrial for core. That's long-term, that's a great asset, right? And you got it at a good price. And so I think, that's going to be the opportunities, but it's not going to be overwhelming. And there's a lot of capital looking for the opportunities. I think it's going to be space in the hospitality space.
Great. So, that's all been super helpful, at least to me, and I'm guessing to a lot of the listeners here. I think one of the greatest parts of our business is always talking about a deal. So, Barbara, let's start with you. Do you have an example of a deal you were working on prior to March 16th that you guys were successfully able to navigate through the chaos and get closed? And then conversely, and we don't want to focus on it too much, but was there one that you lost? I think what would be great for everyone to hear is the reasons you made and the reasons you maybe didn't.
Great. Well, I'm going to give you a couple of examples, two that happened during the COVID period. One was a deal in Ontario, and it was supposed to go hard like 3 days after, this all really got bad. And so, or actually it was like a week after. And, it was a 100,000 square foot building. It was a short-term lease back. It was in, Ontario, good building. And the tenant was selling it with the goal and objective to move to another building. So they'd already leased another building, moving out. They were going to be there for a few months. And I think they were holding their breath, the tenant was, because I think they were like, wow, this could go really bad. This could be not good because we've already leased another building and we have our building. And they were the buyer, who's a well-respected institutional client of ours, called us the day that they were supposed to, waive due diligence, and they said, we've got a little bit of a issue with the roof and some seismic, and but other than that, we're good. And I can tell you that was the quickest agreement of a tenant saying, yeah, let's that's fine, we'll deduct that and let's get this thing closed. And they were holding their breath, and the buyer hard, and we closed right in the midst of this period. It was a win. We had another deal that was supposed to go hard, end of March, and it was in Las Vegas, and we didn't have April rent roll. And it was a multi-tenant park, and everybody knows that Las Vegas is probably one of the hardest hit area. And luckily, the buyer had locked a very favorable debt in place and really liked the asset, and basically came back to the seller and said, we'd like to delay for 30 days. And the seller was like, no, we'd like to close now. So the discussion was, what was the appropriate discount for closing now with no rent roll discovery? And it was agreed upon at about 8%. So those are two stories of things that happened. One with a deduct for some physical, but we probably would have pushed back on that physical deduct in the COVID period. We might have said, hey, I think that's too much or whatever, but the buyer, I think had some legitimate points, and the seller wanted to move on. On the side of the deal that didn't close, we had a deal in Orange County that recently we had you know, a tenant asking for rent relief, not paying rent. You know, we had some issues with the multi-tenant park, and the amount that the buyer wanted as a discount wasn't an amount that the seller would agree to. And we just, you know, the deal just fell apart. And unfortunately, you know, I think there is some disconnect right now on where buyers are and where sellers are. But like I said, we've been able to get deals done during this period, and I'm actually optimistic that moving forward, it's going to be a little bit easier than it has been trying to move through March, April, and May closing deals.
Great. Well, no surprise you got deals done. I think, what did Tim say? You did 80 deals in 2019, which is probably more than I did in my whole career. So you guys keep the train going over there. Kevin, let's go. Same question with you. How about a deal you guys got closed, and one that may have got away?
Yeah, no, I'm actually fortunate right now. We have a lot of deals happening, a lot of data points. As I said, we reached agreement on 3 deals. We closed 2 deals this week. And so things feel better. And there's, on office deals, unlike, you know, I think on industrial as much, there's jockeying on every deal. And the amount of the jockeying on price depends if he's non-refundable or not. If you're non-refundable, you still will, you know, there's 2 deals that Newmark had where $400 million deal. We had somebody walk away from $20 million deposit, and we had another $153 million deal. Somebody walked away from a $10 million hard deposit. And so, and the reason, you know, on the $20 million deposit, the buyer felt there was better opportunities elsewhere. And he was better off, instead of buying a long-term single tenant lease, buying paper on debt and hospitality and generating, you know, mid-20s IRRs. And so, but, you know, there's a deal in LA in the Warner Center, $210 million deal. We had $4 million hard. It was a Middle Eastern buyer. We had the debt lined up. It was hanging in there. And they wanted 12% off. My seller wanted 7% off. WeWork was 14% of the rent roll. But it was a great credit rent roll besides that. We couldn't bridge it. And so the deal blew up. We closed a deal today, $73 million deal in county, single tenant, 13-year lease. It was tied up pre-COVID. The debt markets changed, and the price was changed 6% for debt. The buyer behaved well. It's another Middle Eastern buyer. And so that was the impact was the change in the debt market, which was legitimate. And so, you know, that one closed today. But what we are seeing, I mean, there's one, we closed a deal Tuesday, a life science deal in San Diego. And this will tell you where life science is. And we did 3 buyer interviews. To get interviewed, you had to close within 1 week. So we had a buyer that had a great price that wanted to close in 21 days, and we wouldn't interview him. And we had, you know, our BOV was around 30, right? And we ended up closing in a week at 43 million, and we had an unbelievable bidding war. But that's life science, and so that's life science is a greenleaf clover. Most of my deals are mushrooms and mushroom clouds, and most of them, you know, involve a dance. But the good news is, I think there's more optimism out there. We just reached agreement on with a private party on a deal in LA, $39 million deal. They asked for a $5 million retrade. We settled at 3, so that deal did make this week. But it's definitely feeling better, as Barbara said, and we're excited to get into the last part of the summer. Usually July and August are dead. I think we're gonna have a pretty busy July and August.
Okay. Well, I'm glad you brought some of your Trojan days into this conversation with mushroom clouds and dancing. So we appreciate that perspective. So we're about 5 minutes to go here. You know, what I'd ask is for each of you kind of just to give us a little closing statement where we're going to end up here in the near future. And then we've received a few questions, which I'm scrolling through now. So if you two can give a minute or two close, and then I'll ask you guys a couple of these questions. Kevin, why don't you go ahead?
Yeah, no, I'm optimistic. industrial is going to lead the way out of this. Multifamily is going to follow. And I'm excluding, by the way, the niche, data center, life science deals we talked about. But office is, I think I'm excited about the fourth quarter and the first quarter next year. I think office is going to do well. We just need those data points that are going to take longer for capital to understand compared to industrial. I think, industrial, you don't have the uncertainty about how people are going to use office post-COVID, right? And so, and there's more uncertainty, I think, on post-COVID rents with office versus industrial. So, but I think we're going to come into a really good debt market in the third, fourth quarter. And I think the recovery, you saw what happened this morning on the jobs report. I'm optimistic about the future. It's just, the second quarter here is going to be tough.
Great. Barbara?
So I think that the prognosis for industrial is very positive. There's a couple things that are happening fundamentally that's causing a major shift. Everybody knows about e-commerce, and the adoption of that is happening in adoption so much quicker than we thought. And then the food world, people are really getting used to the grocery, the restaurant delivery. So that's a whole new kind of fast-tracked adoption that's going to be a positive impact on industrial. We also think that there's going to be kind of a reshoring and increased manufacturing back here in the United States. The building that I talked to you about in Ontario that was a case study is a manufacturing building. And I've heard that there's 3 different manufacturing tenants looking at that building. And I think that's something that we're going to see more and more, manufacturing back here in the United States. Also, we're going to see increased inventories as companies really want to have not just in time, but they want to have just in case. And so we're going to see a lot of people keeping stuff in warehouses to be ready. One of the things that Amazon and others have said is they weren't ready for this. I mean, as ready as you thought Amazon would be, you guys all saw when you ordered stuff online that there was a delay, and you haven't ever seen that before. I mean, the reality is this happened much quicker than anybody expected. So those are the factors that are driving the industrial world that I think that the capital markets are going to take advantage of. And we're going to see a lot of interest and a lot of positive news. And I think that, what you've seen with what's been going on with the public REITs and other things are proving up that people have a comfort level with this product type long term.
Great. So we only have a couple minutes left. And Kevin and Barbara, I don't know what your schedule is after this. We have 3 or 4 questions. If you guys have to run, I get it. But if you have time, let's say we extend this out another 5 minutes, I'll hit you guys with these questions. Does that work for you two?
I'm fine.
Perfect.
Okay. All right. So Barbara, first to you. The question is, can you expand a bit in the outlook of multi-tenant industrial parks? You mentioned they were well positioned. Why are they?
So most of the multi-tenant industrial parks, we have seen no new construction of that product type, basically, for the last foreseeable, past. So my situation or my thought process on that is that because of the lack of the construction, because of the lack of product, those are going to stay full. You've got a lot of last mile tenants, smaller tenants that need space. So I think that's why I'm saying it. Short term, that was impacted with COVID because there are a lot more of the, mom and pop companies, maybe companies that were, storing stuff that, for things that were shut down. But I think long term, there's a good prognosis, and we're not going to see any new construction of that product type moving forward as well, probably.
Yep, agreed. Okay, Kevin, here's one for you. Or you both could jump in here, actually. But have the institutional players shied away from California due to split roll and SB 938? So,
by the way, you guys had a nice seminar last week on the split roll and the new proposed legislation. And, I would say this, I think the one proposition's insane. We haven't seen capital shy away with it. And by the way, capital, you're seeing the same type of laws in New York and DC and Seattle too. It's not just California. But the ability to legislate away lease agreements is in changing contract laws insane. So I'm hoping that doesn't happen. But it's that noise has been there, and I wouldn't be surprised if the split roll does pass. But capital still wants to be where the jobs are and where the growth is. And I haven't seen people shy away. I've actually seen friends of mine move out of state to avoid, the state taxes, but capital still loves Southern California and the coastal gateway markets.
Yeah, I agree. Barbara, anything different than what Kevin said?
The only thing I would say is that I really hope, that split rule doesn't pass, because I think, people think it just affects the landlords, but really industrial, those are triple net leases. And those costs get passed through to these tenants that have already suffered, especially some of the smaller tenants. So I'm hopeful that it doesn't get passed. I don't know if that's probable, but I think it's just going to be another hit for why people are moving to Arizona. The interesting thing about this downturn is that through this entire COVID period, the market in Phoenix was on fire and Arizona was really doing great. So I don't know we're trying to track exactly the things, but my fear is that people who are moving out of California are headed towards, other markets.
Yeah, here's that way. All right, we got one more, and then to be sensitive to the time, we'll split here. But this again is for both of you. So Barbara, why don't you stay on the mic? How has rent forbearance affected institutional buyers' underwriting?
So we get that a lot, and that's a pretty, good question. I think that if we're selling something, in third quarter and they had to give a couple months of, rent forbearance or maybe deferred rent, people understand that. People say, is it going to affect the cap rate? I just don't see it. I mean, I think this was a short-term, kind of something that we've never seen in our lifetime. It was unprecedented. And I don't think it's going to have a long-term impact. Now, if we're in and the tenant's still not paying rent, that's going to be a big problem. But if you had to give a month or two relief, whether it be, in the form of forbearance or, some sort of a discounted rent, I don't think that affects values long-term.
It's almost underwritten concessions, right? I mean, it's just part of the package. Kevin, anything out of you?
Yeah, no, you have a lot of people that really don't need it asking for it. We've seen most of that in the retail sector. I think on the office industrial side, it hasn't been as big an issue. But yeah, if you can turn that into getting an extended term, that's actually could be a benefit to the rent roll. But yeah, I agree with Barbara.
All right, well, let's be sensitive to everyone's time. Barbara and Kevin, great job. You guys are true professionals, and we all appreciate from an industry standpoint what you guys do for our business. So keep charging ahead. Thank you for having me on. And Tim, do you have any last closing remarks to this?
Yeah, I just want to thank all of you for being on. Barbara and Kevin, thank you very much. Adam, thanks for moderating. And thank you everybody for attending. Pay attention to emails that will come out on Monday with a recording of today's session. And then beginning next week, we'll be sending emails regarding Spencer Lee and Kurt Strassman on the 25th of June. Thank you, everybody. Have a great weekend, and we will see all of you soon.